Hello, good evening. You're watching News9 Live. I'm Shweta Kothari. With me is my colleague Suyash Maheshwari. It's the day after the budget, and Finance Minister Nirmala Sitharaman, remember, yesterday presented the Union Budget for 2024-25. Nirmala Sitharaman became the first finance minister to present 7th consecutive budget, surpassing former Prime Minister Morarji Desai's record of 6 budgets. Now, in her 7th record budget, Sitharaman outlined key priority areas aimed at fostering economic growth and creating opportunities for the youth in specific. These include productivity and resilience in agriculture, employment, skilling, as well as services. Now, Finance Minister also announced measures aimed at salaried people, job seekers in the union budget, which include a hike in standard deduction for salaried employees from 50,000 to 75,000 rupees in the new tax regime and a rejig of the income tax slabs in the new tax regime. These, among other major announcements, will impact common man, and what will be the larger implication of all the major changes which were announced in the budget. We'll be discussing all that and more. First up, let's quickly listen in to the Finance Minister.
I have 2 announcements to make for those opting for the new tax regime. First, the standard deduction for salaried employees is proposed to be increased from 50,000 to 75,000 rupees. Similarly, deduction on family pension for pensioners is proposed to be enhanced from 15,000 to 25,000 rupees. This will provide relief to about 4 crore salaried individuals and pensioners. Second, in the new tax regime, the tax rate structure is proposed to be revised as follows: 0 to 3 lakh rupees, nil; 3 to 7 lakh rupees, 5%; 7 to 10 lakh rupees, 10%; 10 to 12 lakh rupees, 15%; 12 to 15 lakh rupees, 20%; and above 15 lakh rupees, 30%. As a result of these changes, a salaried employee in the new tax regime stands to save up to 17,500 rupees in income tax. Apart from these, I am also making some other changes as given in the annexure. As a result of these proposals, revenue of about 37,000 crore, that is 29,000 crore in direct taxes and 8,000 crore in indirect taxes, will be foregone, while revenue of about 30,000 crore rupees will be additionally mobilized. Thus, the total revenue foregone is about 7,000 crores annually.
And that, of course, is Finance Minister. Day after the budget, we're discussing the fine print and what will be the larger impact of that announcement. To talk more on that issue, joining us is Harshvardhan Roongta. He's the CEO of Roongta Securities. Also with us is Ritesh Kanodia, partner Aurtus Consulting. He's also a person of interest for indirect tax and advisory. Will be joining us very, very shortly on the show. Will be Vivek Kumar, economist at Quantico. Mr. Harshvardhan, coming to you first. We were discussing this yesterday and we asked you to come up with a rough calculation. I think the rough calculation must have now become a fair calculation of to what extent people are actually going to save 17,500 rupees of savings by the virtue of those announcements made by Nirmala Sitharaman yesterday. How many people will now be incentivized, in your opinion, and people will be incentivized at all to go for the new tax regime?
So, well, Shweta, if you were to look at plain simple calculations, so it is entirely dependent on how much deduction are you going to claim. So say we have some basic calculation saying if your total deductions that you claim under Section 80C and all other put together, if the total deductions are below or up to 1,50,000 rupees, then it makes sense for individuals to move to the new tax regime. In the new tax slabs, they would tend to save more than what they would save in the old tax regime after taking a deduction of up to 1,50,000 rupees. If the deductions are more than 3,75,000, which means that you are investing the total capacity for ATC, you have a house loan interest under Section 24 for self-occupied property, you're putting into NPS, etc. The total deductions, if they go up to 3,75,000, then you would be better off to be in the old tax regime. Now, interestingly, if you have a deduction to claim between 1.5 lakhs and 3.75 lakhs, then it depends on the exact tax slab that you're in, whether the old or the new one makes sense. So some basic calculation that we were doing, if your deductions are in between 1.5 to 3.75 lakhs, then you would possibly be better to go in the old tax regime if your income levels are between 8 to 9 lakhs. And if the income levels are beyond 8 to 9 lakhs, then possibly the new tax regime would be better for you. So I think all individuals could basically just do the basic comparison on their actual situation and decide whether they want to be in the old or the new tax regime.
All right, Mr. Roongta, I have a question for you. I mean, I think this saving of about 17,500 rupees, it's when we compare, you know, the new tax regime before before the tax slabs were revised and after the tax slabs were revised, and I think the tipping point is at about 20 lakh rupees. That's where when you end up actually saving 17,500 rupees. Is that correct, sir?
No, not really. So the 17,500 you would start recovering even if the moment you walk into the 30% tax bracket. So 15 lakhs and above, you're in the 30% tax bracket. So the moment your income is beyond the 15 lakhs, you start getting the benefit of 17,500, which is also including the standard deduction, which has been increased to 75,000.
All right, and that is as far as you know, income that you'll be saving by the virtue of the new tax regime. Now, but before I move on from that, what is your understanding of how quickly the government is going to let go of the old tax regime? There was an admission by Finance Minister in her speech yesterday itself that we are looking at phasing out the old tax regime. Do you see that happening anytime soon?
Yes, most certainly. In fact, you see the government is fully focused and encouraging the new tax regime altogether. I mean, you would see that there has been no mention or no incentive given to the old tax regime in the form of increasing limits under Section 80C or the Mediclaim premium under Section 80D, etc. So it is very clear and apparent that we are going to move to the new tax regime. The new tax regime is the default option when you want to file your returns. In case you want to move to the old one, then you have to specifically select it. So I think these are signs, and additionally, the finance minister also said that they're working towards simplifying the entire income tax act. So when we move into that direction, I don't think the new simplified version of the income tax act will have any mention or any provisions for the old tax regime. So I think it's only a matter of time, maybe a couple of years, if not more. I mean, it could be possibly 1 or 2 years maximum, by when we will see that the old tax regime would be redundant altogether.
All right, old tax regime looks likely will be redundant very soon. Let me quickly get in Ritesh Kanodia into this conversation. Ritesh, a lot happened there by the way of indirect taxes as well. GST, of course, wasn't a part of that budget speech, but more or less did feature in you know, Finance Minister's array of subjects that need to be re-looked at. In fact, a group of ministers there need to be reconstituted. That is what came out of the GST Council meeting, at the last Council meeting that we heard from. Your big takeaways on what indirect tax changes are likely to affect people and to what extent from this budget?
So, Shweta, we are seeing a lot of rationalization which is happening on GST. A lot of clarifications are being issued. So, you know, when GST got implemented in 2017-18, everybody is aware that there were huge challenges in terms of its implementation and there were open interpretation issues of law. Gradually over time, what we have been seeing is that the government is issuing clarifications, you know, to sort of ease out or iron out those issues. Like in the 53rd GST Council meeting, a number of such interesting clarifications were issued. Now, as far as the budget is concerned, as you rightly said, GST sort of become a non-issue. But all the substantive amendments which gets recommended in the GST Council meeting gets implemented, you know, by way of a finance bill because the GST law needs to be amended.
Right.
So that is what has happened, and you know there are 2-3 very interesting amendments which have happened, more specifically from a litigation perspective. So one is the amnesty scheme. As I said, there were a lot of issues in the past on, you know, demand notices being issued for GST, etc. the government has come out with an amnesty scheme for waiver of interest or penalty. Now, unfortunately, the amnesty scheme is only restricted to certain situations where there is no allegation of fraud or suppression and doesn't cover situation where the authorities would have alleged that I have done a fraud or a suppression. Having said so, it sort of helps the taxpayers who want to sort of close their pending litigations, pay the tax demand and sort of move away after paying off interest and penalty. So that's one interesting thing which has happened, and the provisions have now sort of got proposed in the finance bill. We'll yet to see the rules around it in terms of how it actually will span out.
All right.
Interesting.
There were
Yeah.
other changes with respect to basic customs duty, of course, on mobile phone PCBAs, custom duties on 25 critical minerals, along with other important changes in indirect tax structure regime, and the government was of course of the view that we want to simplify and rationalize some of these tax structures in order to ensure that the benefits of GST are multiplied over time. Ritesh, I want to understand from you, how much are we foregoing by the way of these changes in indirect tax regime?
So, see, there is a huge issue which is prevalent both under the customs and the GST law, which is with respect to inverted duty structure. Now, most of this reduction on custom duty are on two accounts. So, one is primarily addressing the inverted duty structure issue. Second, the government is very keen on Make in India. So, what is happening gradually is that finished goods are becoming expensive and the raw material duties are being reduced. Basically, to provide boost to the Indian manufacturers who could then go and manufacture those in India. Otherwise, they sort of become non-competent.
Okay.
So that's one thing happening under customs, and even under GST, for example, we are seeing a lot of rate rationalization from the perspective that if there is an inverted duty structure, which means that your credits are higher than your tax payments, and those credits gets accumulated in the system, which basically leads to a cost. So government has been working across those items where the inverted duty structure is still prevalent. And Shweta, I just want to add one more thing, that the GM committee that you've talked about is primarily to look at the overall slab rates. So there are currently 4 slab rates which are prevalent, and there is a large discussion around as to whether those slab rates would get consolidated and concised so that the laws become simpler. So the
Okay.
GM committee, because of the change in the government, there are new members, and they would again sort of relook at all of these aspects and then come with their proposal on how the rate needs to be rationalized. So this was on the GST front.
All right.
All right, and Ritesh, also basic custom duty on both gold and silver has been reduced from 10% earlier to 6% now. Now this is expected to reduce the prices of both the precious metals in the local market and also boost the demand for these precious metals. But it's I was also reading that it will also reduce the risk of smuggling. Can you help us understand that?
See, it's always the situation, right? Whenever there is a higher rate of duty on components, then there is also parallel economy which tries to, purchase or bring in those components without paying a custom duty, correct? Because if they import through the regular channels, they would have to pay such a higher custom duty. So reduction in customs duty would sort of motivate those importers to bring it, through the regular channels on payment of custom duty. And gold, silver were, some of those items where the smuggling was very largely prevalent, where the imports were happening, let's say, for example, import from Dubai, where people used to bring it in their bags, etc., and sort of try to import it without payment of duty. Maybe this will, motivate people, not to sort of indulge into those activities, because the gold could become cheaper if they get imported 6% duty and they can just buy it over here.
All
So
right.
yes, it does help to curtail the parallel economy.
Yeah, and I think there was an impact on gold prices as of today.
Yes, certainly.
And we'll come back to you on that. But let's also quickly get in Vivek Kumar from Quantico joining us on the show. Vivek, thank you for being patient. I think one question that I have to ask you at this point in time is that, we were hoping for big bang changes from this budget and, some drastic rationalization of tax slabs and all of those anticipation building up to some small savings of about 17,500, albeit not too small. Any money is good money. But something we did not anticipate was perhaps a further consolidation fiscal deficit target to the to the tune of about 4.9% now. So it does look like all the money that the government has been able to shore up will be moving towards further consolidating finances and meeting that stringent target of about 4.9%, including the 2 lakh crore bonanza that came by the way of RBI dividend. So not a lot of money there being spent on welfare activities. Is that how you are seeing the budget? Because that is at least what the people on the outside are saying. I can't hear you. I think you're on mute.
I'm so sorry about that. I hope this helps.
Yes.
Yeah. So thank you for having me on the show. Good to be back. And you're right that we had a bonanza from the RBI in the form of record high dividend payments of 2.1 lakh crore. And that has clearly changed the fiscal game for financial year 24-25. Now, as a ratio to GDP, since we're talking about fiscal deficit and it's readily known as a percentage of GDP. Now, if you were to quantify the additional RBI dividend as a ratio to GDP, it was roughly around 0.4 percentage points of GDP. Now, what the government has done is that it has chosen to take half of that to reduce the fiscal deficit, which helps you to explain of why fiscal deficit vis-a-vis the interim budget estimate of 5.1 moved lower to 4.9. The other half is now being channelized towards higher revenue spending. So your revenue spending has actually gone up from 11.2 percentage points of GDP in the interim budget to 11.4 percentage points of GDP in the July budget. So that's the switch. So that 0.4 percentage points of GDP is roughly equally divided between compressing the fisc on one hand and increasing the revenue spending on the other hand. Now, just to remind you, revenue spending is the major chunk of spending which actually captures the welfare bit of spending which the government does. Because the budget is classified according to two major types of spending, revenue and capital. Capital is more productive, which goes into long-term asset creation. Right. And revenue spending is more near-term, which probably is more linked to consumption. So you could argue that the gains or the bonanza that we got is getting divided equally.
All right. So not all of it towards revenue spending. A lot of it, in fact, half of it towards reducing that fiscal deficit target, at least to, from 5.1% to 4.9%. That's the estimate for financial year. I want to talk a little bit about the capital expenditure. It has remained intact at about 11.11 lakh crore rupees. Was an expectation here that perhaps the capex spending, at least in the final budget, will be upped. And there is also an expectation, of course, at this point in time, the government says we've done enough. We've done a lot of heavy lifting. It is perhaps about time for a private sector to finally start acting up and take some responsibility for that capex development?
Well, it's a fair question to ask because in the run-up to the budget, there was some speculation in the market that the capex budget might see a minor increase. So people were looking at a 10 to 30,000 crore increase. It was nowhere close to the overall allotment that was there, but nevertheless a minor tweak to just signal the intent. So that was the speculation in the run-up to the budget. Now, from a practical point of view, which also you highlighted somewhere, I think we've also got to keep in mind that the current level of capex outlay, which as a ratio to GDP is at 3.4 percentage points, is the highest in nearly 2 decades. So sustaining that kind of capex budget year after year, in fact, year after year, increasing it every year, is going to be a tall ask, especially when you also want to consolidate your headline fiscal deficit. So we've got to keep in mind the overall objective also, because the government also wants to get back to 4.5% and maybe even lower on the fiscal deficit front in the coming years. So, on one hand, you cannot keep pushing the pedal on capex. So at some point in time, the private sector has to take the baton, and this is something which the economic survey also emphasizes very clearly, that the private sector now needs to come on board. The balance sheets are healthy. Most of the roadblocks or hindrances which were there have now either dissipated or now they have been replaced by more healthier avenues and alternatives. So clearly the government is banking on that part. From a practical standpoint, I think another factor which stands out is the fact that out of 12 months in the year, 4 months have already passed in the election season and the government formation. So even if the government is able to meet that 11 lakh crores of capex budget, I think it would be an achievement, because actually they would be meeting that 11 lakh crore target in a shorter time span rather than a full 12-month period.
Right. Okay, all right. Well, that is, of course, as far as government's capex cycle is concerned, there is an expectation, Suyash, that finally private sector will fire all its cylinders,
Yes,
and that has come in by the way of economic survey as well. But let us quickly, because we're running short on time, let us quickly also try and touch on the big dampener that has come in from the budget, at least what people are saying on social media, a point of discussion with respect to loss of indexation benefit on certain assets. Now, we didn't know what those certain assets were when the budget speech was on, but the moment it was finished and we had the fine print of the budget, it was real estate and other, of course, other assets there, non-listed, and that people were not very happy about. Run our viewers through what has happened here, and perhaps we can also get Mr. Roongta to weigh in.
Sure. So Shweta, one of the things I think before the budget, most of the market experts, they were hoping for, some bit of a uniformity, a simpler tax structure when it comes to capital gains. Now, it did happen. I mean, to a certain extent, the FM delivered on that promises. But as you rightly pointed out, certain, the taxation on certain assets got increased by a lot actually, and property being one. And if you can take an example very quickly, so basically what indexation allows you to do is that it allows you to, for the purpose of taxes, it allows, instead of minusing the purchase price of your asset or your flat, you are allowed to, adjust it according to inflation and minus the what the property would cost you today. So for instance, let's say you purchase a property back in 2001 at a cost of about 10 lakh rupees, and that you sell it today in financial year 2024 for about 50 lakh rupees. Now the actual cost is 10 lakh rupees, but if you adjust it, if you index it, it would come to about 36 lakh rupees and 30,000. So on that you so you minus that 50 lakh from 36 lakh 30,000 rupees, and on about 13 lakh 70,000 rupees, you pay a capital gain tax of about 20%. So your tax liability would have worked out to about 2 lakh 74,000 rupees. Now, even though the long-term capital gain tax has been reduced from 20% on property to 12.5%, indexation has been done away with. So essentially, you'll minus 50 lakh. You'll minus 10 lakh rupees, the actual cost of that flat, from 50 lakh rupees, which means that your capital gain is actually 40 lakh rupees. On that,
you're paying 12 and a half.
You have 12 and a half, which works out to about 5 lakh rupees.
All right.
So essentially, you're paying 2 lakh 26,000 more, about 82.5% more tax in this scenario.
Mr. Roongta, do those numbers make sense to you? The calculation that we've just put out for our viewers right now, does this mean that the tax liability of an individual increases massively, sometimes even doubles, if you've taken a property after 2001?
Yes, that's correct, Shweta. So Suyash has done the calculation correctly, wherein it is apparently very clear that the indexation benefit has been taken away. So, and they've tried to make good that by setting a uniform long-term capital gains tax rate, which is 12.5. However, specifically, you'll have to take into consideration all the costs that you're going to be incurring. Now, this is for a property for a calculation for a property purchase post 2001. The Finance Ministry has come out with a clarification stating that although property which is bought prior to 2001, they will continue to get the indexation benefit. However, there seems to be a clarity which is pending to come, as if there will be a fair market value taken of those properties. Hypothetically, somebody's bought a property in 1980. Now, you will take a fair market value of that property as in 2001, and you will then calculate the tax liability. In this particular example, which Suyash had taken, it was property purchase post 2001. So there is going to be some distinction between the two things, which will need to be understood clearly. However, if the impact has to be seen, yes, with the indexation benefits going away, there could be an instance of higher tax liability on property owners.
All right. How are we to actually see this higher instance or a higher liability of tax? Does it look like the government at this point in time is penalizing people who may have purchased a property or inherited property post 2001? Because that is the reading, at least on social media. There's of course a call also, Mr. Roongta, by various corporate leaders and industry leaders for the government to actually relook at LTCG changes.
And why 2001 in the
Yes,
first
sir.
place?
Yeah, so see, because the benchmark date was reset to April 2001 from 1981 earlier, so that's why 2001 has become the date on which the segregation is happening. Nevertheless, Shweta, what is important is that the right to indexation was actually very genuine. You must understand the purchasing power of money keeps reducing over a period of time. Now, if you purchase something in 2001, say for instance, and you are going to sell today in 2024, now you have to understand that the cost of that money is not going to be the same as it was in 2001. So there is an indexation benefit given so that the inflation, the impact of inflation is incorporated, and you pay tax only on the gains that you make above that inflation rate. Now, having said this, if you've taken away the entire indexation benefit out, all you know that the person may not be even beating inflation, and he or she lands up paying tax on that. So I think it's a fair call by people, individuals requesting the finance minister to have a relook at indexation benefits being offered back for at least real estate, if not any other assets. But indexation, even on debt mutual funds for that matter, has been now taken away. So indexation just basically takes care of that inflation part. And then any gains made after that has to be taxed. It's a very fair way of calculating tax liability. So hence there is a genuine call for indexation benefits to be restored back at the time of calculating capital gains.
All right, that is of course as far as indexation is concerned, and the controversy which is likely to continue, at least social media going in full fervor. There are calls to the government to relook at some of those benefits that people were accruing. Whether the government is going to relook at that, we don't know, but this wouldn't be the first time that government came out with something and tried relooking at it. Ritesh, angel tax is one of them. Angel tax had to be done away with because nobody liked it. Startups were strictly against it. It continued for a while. It hampered their ability to raise capital, and it spent that capital as and how they liked. Angel tax done away with, was that expected? Of course it was expected, but my question to you at this point would be, how much are we foregoing by the way of indirect taxes, by the way of, giving way for more basic customs duty and lowering them and doing away with angel tax? Is that going to dent the money that we will shore up in form of indirect taxes in financial year 25?
Shweta, I don't think so. The government is going to forego any revenue because there has been a lot of discussion around tax buoyancy, where collections have increased, and there are this amendments of capital gains, etc., where the rates have been enhanced. Even from a GST perspective, the collections have been improving. As far as this entire angel tax issue is concerned, this was more of a litigation. I don't know how much realistically did the government collect any money from those, because it was
Okay.
more about, whether that tax is applicable. And I think most of those companies were under a litigation scenario. So, it may not be called as
Many,
a
many
sort of
companies. I think we covered many, many of those companies who were either under litigation for the GST overdues or for angel tax.
Correct.
And the fact that the fair market value of a company was so difficult to actually calculate that we had to sit down with our calculators and get experts on the show to make us understand what the fair market value is.
Correct, absolutely right. And see, with the schemes like VDS and now the GST amnesty scheme, I'm pretty sure there would be companies who would want to sort of pay past disputed amounts, and so that would give an additional source of revenue to the government. And while there was no mention of this entire, the public sector, whether the government would sort of, sell their stake, etc., but maybe that is another source of revenue which is always available. So I do not see, and you've heard about the fiscal deficit, right, which is
Yes.
pegged at 4.9%, which is, and next year 4.5%. So I think that there is a plan in place. So while there would be some revenue foregone, I'm pretty sure there would be, a lot of things which would be sort of coming in, like
Okay.
custom duty, inverted duty, duties have increased because of that. So it's not only
Right.
reduction.
And a lot of money hopefully coming in, Mr. Roongta, by the way of increased and a bigger tax net, perhaps this time around. But that, of course, is one of the expectations the government has, to increase the tax net, get more people to actually file taxes, even if it's nil tax. And the date is around the corner, 31st of July. It's a good time to also remind our viewers right now to file their income tax returns.
Yes, you're actually right. So, in fact, we would go ahead and encourage everybody to file their returns, even if it's a nil return. I mean, it's good to have a track record and a continuity with whatever you may not be in the tax slabs, you may be in the with minimum tax slab, but it's always right, good to file your income tax return, because this document would also help you in many other places. I
Right.
mean, if you're applying for a loan, if you're applying for visas, you are filing your income tax returns, though there is no tax liability, but there is no harm in at least filing your tax returns. So I would encourage everybody, for that matter, to file your tax
Absolutely.
returns, even if you don't have any tax liability on it.
All right, gentlemen, thank you very much, the two of you, for joining us on this show, and to Vivek as well. Thank you for taking time out. Thank you for joining us to understand really the fine print of Budget 2024. A lot of information, of course, still coming out as we try and analyze, break down for you, our viewers, as to how the budget will impact you, impact your finances and your life in general. But with that, from me and Suyash here, it's a wrap on this show. Thank you very much for watching.